What a perfect day to speak with Dominic Konstam of Deutsche Bank. Let's bring him in right now. Good to have you here. What a weekend. What did you watch this weekend? Did you try to get away from this? Or, well, I was watching the news flow off the Bloomberg of the Greece vote, and then about Saturday I switched to Italy.
Well, yes. I mean, you were sort of looking at all the sort of headline risks in Greece and stuff like that. But to be honest, what I was thinking about was how sad it was that things seem to be breaking apart. And we keep looking in the rearview mirror at the latest problem, but people aren't necessarily looking ahead at what's really happening, which is a potential breakdown of the monetary union.
A breakdown of the union where someone leaves or sort of leaves. It's a big game of chicken. How do we jumpstart the process to get past that to real solution? Who jumpstarts that?
I think the only solution is from the ECB, the central bank. I think the only thing that will really save the monetary union will be if they can and will monetize the debt of the peripheral countries.
Will Germany allow that? It goes against everything they know from the 20s and 30s, doesn't it?
It does, and you know, the risk is there's a massive political backlash from Germany, and they basically refuse to sign up to it, and they're the ones who in the end decide to leave. So I mean, this isn't going to be something that's going to happen anytime soon in the next few months, but over the next year or so, as Europe goes into recession, that could be a big issue.
Okay, I want to show two charts. Victor, bring up here the Berlusconi Moonshot. This is dreaded first chart, and you can see here the Italy-German spread, and it just goes back 5 years, and you can see the quiet and then the churn, and then this moonshot, many deviations out. Really, Italy-German spread now way out. Where are we exactly? We're at 489 beeps. We've worsened, Dominic, in the last bit here. Is this about German yields getting lower, or is it about Italian yields getting higher?
Well, it's a little bit of both, but it's really about Italian yields going higher. They're sort of crossing the sort of, they're potentially going to be crossing that sort of 7% threshold. And the other countries that have needed bailouts, you know, they all went through the same thing, so it's looking remarkably similar. The difference is Italy is a massive bond market.
Yeah, it's a big. How much bigger is it than Greece? I'm sorry, I can't remember.
Well, they got 1.6 trillion, I think.
Yeah,
several
it's a lot bigger. With a lot. Here's the chart, folks, that the pros look at. This is the intraday Italian 10-year. And you can see here, nighttime, daytime, nighttime. And up we go this morning with the rumors of Berlusconi out. Here's a sigh of relief. And just in time for surveillance midday, we've widened out to 6.7%. And you say 7% is a real important threshold.
Well, I mean, around these levels now, because there's issues with the clearinghouse, the London clearinghouse, and the margins on owning these bonds. And
who owns them on margin?
Well, if you're going to margin them through the well, I mean, a lot of investors will have calls on these bonds, leveraged investors, for example, banks potentially. And so the idea is they would, you know, they don't want to hold these bonds if they're going to have the higher margin calls on them.
Let's do credit default swaps. How does this trauma fold into the people that are the counterparties or on the other side of these credit default swap agreements? Where are they right now? What's their mood?
I think that's really difficult because obviously with Greece, you know, people thought they owned CDS, and so they were protected against a sort of major loss, let's say, on the principal. And now we're being told, as this glorified PSI, that CDS is not going to be triggered. So I think this whole CDS market is in a little bit of a turmoil. They don't really know whether you're protected or not. What is CDS actually worth? I mean, is it possible that you could have a 75% loss on a bond and not trigger CDS? I mean,
how is that possible, and how does that work out?
I mean, it doesn't sound.
Let me rephrase that. How would you guess that works out?
Well, I mean, I guess there has to be a point where it's in the interest to sort of trigger the CDS. I mean, it doesn't seem to make sense that you've been buying insurance and then somehow you're not allowed to sort of claim on your insurance in some sense. So what is that threshold? And those are all, and then you get all these complications where people they think they have CDS and they get rid of it because they're not sure it's really worth it. So I don't really think we know the answer to that.
There's a mystery here, and part of the mystery is a set of outcomes. There's a wide set of outcomes, and we really don't know what they are, do we?
No, but what you do know is that behind all of this, there is this internal capital flight taking place, whereby money is leaving the periphery and going to the core.
Dominic Konstam with us, and we're going to rip up the script here. You want to talk about something that's dear to my heart. which is beneath it all, where's the money moving? I keep looking at Eastern Europe and the challenge of the Austrian banks. Where is the money moving in Europe?
Well, in Europe, a colleague of mine, Thomas Meyer, has unearthed some fascinating data in the last month or two of how we always knew that money was leaving Greece and going into the core countries, but now you're picking it up that it's, a lot has left Italy in the last month or two. So I think in the last month alone, they lost around 100 billion or so euros. And Italy used to be a creditor nation within the euro system, and now it's actually obviously a debtor nation.
Tom Meyer, I featured in Bloomberg Business Week's Econo Chat, which was published this morning. He was out in Zero Hedge last night with some language. His great caution about the European experiment. Tom Meyer was way out front on the collapse of Europe, as you were way out front on lower interest rates. Can interest rates even drive lower from here?
In the States, they certainly can. I mean, I think the Fed is itching to do more accommodation. They just haven't yet figured out exactly what they want to do. I mean, you showed a chart earlier on the unemployment rate trajectories, and it's also looking very bad. Unless we grow very strongly, unemployment's not coming down. So the Fed's not raising rates for 5, 6 years or even longer. So there's no reason why 10 years aren't going to go to 1.5%. And in Europe, there's a possibility that German yields could obviously go very low and possibly even negative if people start thinking
a negative German yield?
Possibly. I mean, they've already been there in the very front end, but the idea is that it's just possible if you think there's even a chance of a breakout.
That's a break exclusive. Dominic Konstam considering and suggesting negative rates in Germany. Earlier this morning on Bloomberg Surveillance, I spoke with one Stephen Hankey of Johns Hopkins University and the Cato Institute, and I asked him what he thinks about Paul Krugman.
He's been wrong since day one on this stimulus thing. I mean, the stimulus hasn't worked, and the reason it hasn't worked is that it made people so nervous that the deficit is so large. In my view, it's pushed the economy back. And the key thing, again, is money dominates always. It doesn't really make so much difference what you're doing on the fiscal side as what's happening to the money supply.
One of the great monetarists, no shock, disagreeing with the good professor from Princeton. Paul Krugman's looking for stimulus. He wants to see some dollar wallop to solve some of these problems. Is he right?
Well, I think he's right that you don't basically tighten policy into a recession, because the risk is you're just going to create a depression. So in that sense, I think he's absolutely right. And Europe's problems are very much those at the moment. I mean, that's why all the rioting is on the streets and why Greece can't bring in its deficit, because you're forcing the country into a recession faster than it can sort of maneuver on policy. So that's kind of that is absolutely right.
I know you can't speak for Deutsche Bank, and I don't want you to get into trouble, but Mellon of a few years ago, a Secretary Treasury, doesn't look like Tim Geithner. Andrew Mellon would have said, liquidate, consolidate. Why can't we start merging banks together to clear the markets?
I think that is something that's probably going to end up happening. So obviously there are weaker banks in Europe, and as you sort of go through this mess and assets are written down, some of those banks will invariably have to be consolidated. I mean, in an extreme case, you can imagine some banks might actually get nationalized.
This has been wonderful. Thank you so much.